Welcome to the Intro to Profit section of the course. It takes far more than just winning trades to be a profitable trader. This is because a trader can have more wins than losses, but still negative in profit. More importantly is not the amount of wins compared to losses, but the size of the wins compared to losses. Once you understand this, then you'll realize you can be profitable even if your losses are more than your wins. We utilize a few things to maximize our profits and minimize our loss. This includes risk to reward ratio, trade supervision, position sizing, compounding, and journaling, all of which requires great discipline. Let's begin with risk to reward ratio. What is risk to reward ratio, or RR? It's simply the difference of your stop loss and your take profit. So if we look at a 1-to-1 RR scenario, you're basically saying I'll risk 1% and attempt to make 1%. 1-to-2 RR would be risking 1% for 2%, and 1-to-3 RR would be risking 1% for 3%. But honestly, it's just a number. It's easy to say that you want a 1-to-10 or 1-to-100 RR, but note that's just in theory. In fact, you're more likely to get the market to give you 10 pips before a pullback. For our strategy, we focus on acquiring 10 pips, and if the trade is going against us, we cut the risk in half. Or if the trade is nearly at our take profit, we close partial profits and move our stop loss to entry, making it a risk-free trade and limitless reward. This has proven to be the best method to maximize profits. Additionally, we only enter the trade if the stop loss makes sense. That would mean at least giving us a 1-to-1 RR trade. Our risk should always be equal to or less than our reward. This method allows us to have larger winners and smaller losses, even if our winners happen to be fewer. We couple this with position sizing. Position sizing will dictate our transaction volume or lot size. There's many places to find a position size calculator, but I like to use cashbackforex.com. Under tools, they provide a nice position size calculator. We choose our instrument, and our currency is USD. Choose stop loss in pips and enter account balance. Lastly, we put our risk amount. An ideal risk amount is 0.5 to 2%. Never risk more than 2% per trade. Let's say we're using Euro USD. Our stop loss is 8 pips. The account balance is 10,000 and we're risking 2%. That gives us a 2.5 lot size. We're looking at approximately $25 per pip. This is where compounding comes into play. Let's say it was a winning trade and it ran 20 pips with our 2.5 lot size, giving us $500 profit. Now our account balance in the position size calculator is 10,500, providing a new lot size of 2.6. When we compound our account, it allows us to increase our lot sizes with the same percentage of risk. Compounding is a great way to get into a business mindset with Forex. So when we deposit into an account, we should always think of it like a business. And finally, we have journaling. Journaling your trades is extremely helpful. It will allow you to review your wins and your losses. Having the ability to look back on your trades and create a sample size of all your trades will provide a great deal of revelation. There's numerous things to be discovered. You may find that you have more successful trades during a specific session or trading a specific pair. I provided a sample Excel sheet that you can use to start journaling. Also, it's good to snapshot your TradingView chart before your entry and another snapshot after. This will give you a visual glimpse for reference as well. Well, that wraps up the Intro to Profit section. I'll catch you in the next section, Psychology.